Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Today, I'd like to talk to you about old, established, and very large mutual fund schemes. In the equity category, I must stipulate, the idea is, and a lot of people talk about this, the ability to be nimble for a fund manager reduces as the assets go up. And we were talking recently about Parag Parikh FlexiCap fund, which now has an assets under management of over 1 lakh crore. HDFC FlexiCap is another that has a very large amount of assets under management. Nippon Small Cap Fund has now 240 odd stocks in its portfolio and is handling well over 55,000 crore rupees of assets under management. Does that make it harder to beat the benchmark and beat the peers? Are nimble players, smaller players better placed? To find out and get you the answers that you need, I'm joined today by Kshitij Mahajan, who is the Chief Executive Officer of Complete Circle. Thanks so much, Kshitij, for joining in, for taking the time. And this is an important question to ask. So what does the data point to?
So Alex, thank you. Always a pleasure to be with you on this show. I think it's an eye-opener for many of us also when we, go level 2, level 3 and do our research on the data points. And one can see that, there are some outperformance in the funds, but large cap has its own, let's say large funds has its own plus and minuses. But yes, most of the funds which have been managed proactively very well, they're able to beat the benchmark, let's say by 70 to 80% at least. So there have been instances that on 70 to 80% times they have been beating the benchmark. You talk about Parag Parikh, it is 100%, it has 100% outperformed the benchmark, and there's a catch to it because it has some foreign allocation also in the portfolio, and that has also sometimes helped. Sometimes it has dragged the portfolio return, but yes, it's such a huge fund, and think about 1 lakh crore of a single fund doing that again and again, and there is no recommendation. We're just talking as per example per se. There have been HDFC Midcap, which is the largest midcap fund with 80,000 crore corpus. It has beaten the benchmark by, or let's say, most of the 80% of the time it has beaten the benchmark. So there are large funds, and if you can show on the screen, there have been ICICI Pru large cap, Nippon small cap, which have been doing this consistently over 100% times over the benchmark. So I'm saying that we have seen that not every fund, but yeah, few of those category funds which have been managed in the right spirit are doing that. But yes, as we discuss going further, there are some drawbacks, or there are some negatives also about being having a large corpus in a scheme.
Yeah, and one of them is the inability to deploy very quickly. And the necessity, Kshitij, if you agree with that, particularly in a mid-cap or a small-cap portfolio, to have a pretty large holding of large caps or to have cash. Because if there is redemption pressure, you have to meet that in liquid stocks. And that means that in a small cap fund or a mid cap fund, you have to have 65% in mid cap or small cap respectively, which allows you a portion of money. And Parag Parikh, you mentioned, at the last count, I haven't seen the latest fact sheet, but at the last count that I saw, 24,000 odd crore rupees in cash and cash equivalent instruments. And so what are we talking about? This is a scheme that has managed to beat the benchmark and beat peers because it has fallen less than the market, and you can do that when you have a significant amount of cash. Would you agree?
So there are two aspects to this. One is when they were maintaining cash, and what we have seen was 10 June, and the next fact sheet will come by 10th. It's because of the market opportunity at that time. We have seen market around 24,000 levels, and there was clear-cut opportunity when they can deploy the cash also, and a lot of money which flows into them because they have a huge SIP book also. So now, on an average, if at that time 10-15% is being managed by most of the active funds as cash component. Now, second point is when you have the powder dry, you deploy when markets are lucrative. Second is that, yes, for redemption pressure, many of these large funds, they need to maintain that type of cash, and your small and mid cap exposure in a flexi cap category also reduces. As small and mid cap, if with that huge size of fund, you deploy funds, when you're redeeming, it takes some time. If you remember, SEBI has started this exercise for small and mid cap, where they keep on checking their liquidity every 15 days, how much you can redeem in 15 days to 30 days time. So that is something which they have started. But yes, having said that, especially for specific small and mid cap fund, if they are maintaining 65% with such a huge corpus, they need to enter into lot number of stocks. And further also, if you don't want to take exposure, they have to keep a substantial amount in cash or large cap to, yes, honor the redemption pressure.
You know, we often speak about the flexi cap category because they have the largest scheme, but I want to focus on the others that you've shared data on, and in the mid cap space, in the small cap space, and in the multi cap space. You've picked the largest schemes, right? So in the mid cap space, we're talking about HDFC mid cap, and you've said that over the last 5 years, on a rolling basis, it has managed to beat the benchmark pretty much 80% of the time. What goes into that, and why have the more nimble, the smaller funds not been able to do that?
So interestingly, what has happened from 2020 September onwards, after wave one, small cap and mid cap sector was not performing after the recategorization of mutual fund. If you remember in 2018, where the recategorization happened and long-term capital gain came into play. So small and mid, and GST also came into play. A lot of things happened in 2018. So small and mid cap was not doing well. In fact, calendar year return for 2018 for small cap index was 57% negative and 48% for mid cap index. But yes, to 2020 onwards, because there was a valuation mismatch, they were trading at a lower premium, and that's how they started catching up. But I think they've been managed also very well. I should give credit to the fund manager also at the same time. And there was a lot of capital inflow which kept on happening because of the performance in this sector. And small and mid cap as a category has done really well over a period of time. But yes, there are many small size funds also which are not able to do that vis-a-vis index, where an HDFC, a few others have done. So I think it goes to credit goes to a lot of fund manager also. Credit goes to a lot of stock picking ideas also, the research team also. At the same time, credit goes to managing the inflow as well as outflow part also, because they've been managing cash most of the time more than 7-8% in the portfolio. I think that is also really interesting the way the fund has been managed.
Okay. So just a quick point on this Nippon India Small Cap Fund. It's been a lot of people have tried to write them off, but unfortunately for the people that have tried, they keep outperforming. The question is, will that sustain? As you pointed out, 240 stocks in a small cap portfolio, it's very, very large at this point. Is there a risk here?
Alice, we'll do with 55,000 crore of small cap corpus. As per category, you have to invest 65% in those companies which are at the 251st number in an index as per the market cap. 100 is large cap, 101 to 150 is mid cap, 100, 250 and 251 and up to 500 is what you can look at the small cap, or little ahead. I'm saying now what they have interestingly done is they have increased the number of stocks. To de-risk themselves, right now the allocation is between 240 stocks. And it's not they are just maintaining 65% in small cap. They are more than 70% in small cap. Samir Vartak is a great guy. The way he has managed that size of small cap, I think kudos to him. We've been, so, it's a matter of chance because I work for Reliance and now it's Nippon. I keep on saying Reliance small cap, but yes, this Nippon small cap has done really well. But again, people who are watching us, they need to understand whenever they are allocating in any fund, whether small or mid cap, just don't look at the past performance of that fund. Moreover, the goal plan which you are aligning with small and mid cap, as per our discussion also, should be in excess of 10 years, because the type of performance which small and mid cap have generated in the last 3.5 years, you might see a lull of year and a half, maybe year or year and a half going further. Having said that, the SIP is the right way of doing for a long goal of 10 year plus.
Okay.
So I think they are diversified.
Point well made. So therefore, what do you need to do? Let's come to the bottom line, the pros and cons. One would argue that having an investment in a large scheme, and these are the largest out there, gives you the advantage of a very low expense ratio, because as you go up the ladder in terms of assets under management, the SEBI rules require the fund house to reduce the expense ratio. So that's a big benefit. Also, we've established that these are pretty well established, well managed funds. So should you pair, for example, in a small cap category, a large scheme like a Nippon with a smaller, more nimble scheme, as long as the portfolio duplication does not take place? What is the advice here?
Makes sense, but my suggestion here is, or like what I will like to do is that, let's say if you have a large category fund in terms of in portfolio, you can complement or pair it with, as you said, with a small category in a different basket. Like if you have a small cap which is a large category, take a mid cap which is a small corpus. That's what you can do. So it has, as you said, advantage of low expense, advantage of a large fund will be from a large fund house, a better research, bigger research, advantage of better liquidity, because you will not have a liquidity crunch on your side. Let's say, as you said, 24,000 crore cash is what Parag Parikh is maintaining. Tomorrow, if there's a liquidity pressure, they can manage it well. Okay, and liquid can also give you 6.5% return. Now the return will further reduce, but I'm saying a lot of pros are there, and there are obviously cons are there, because you can't take you can't take a meaningful bet in a portfolio. If the fund size is small and a large, then if you want to buy 5% in a portfolio, then you have to take 5,000 crore in a fund like Parikh. That means you can't take a substantial allocation toward a large company or a small company. So that's a negative side. And at the same time, there are other negatives also, like, in terms of managing the cash in the portfolio. So I'm saying overall, it's a good strategy to complement your large size fund with a small size fund, but in a different category. Not necessarily take small cap only.
Got it. So closing lines then, and ultimately you want to have a well-diversified portfolio and you want to have top performers. The tendency, as you've pointed out, is to go for the top performers, and ultimately in several categories, these are the top performers. So how do you determine how to choose the schemes that you need, and how do you reshuffle? Because you could see a situation, Kshitij, and this is the last point that I'll make, where conservatism, because of a large assets under management, will lead to underperformance down the road. How do you balance that?
So largest AMC in the world is BlackRock with $12 trillion of assets. So that doesn't mean their funds doesn't perform. But at the same time, please understand that you need to have a balanced approach of the size of a fund also. You can't have, okay, all these large caps are doing well, large funds are doing well, and Kshitij and Alex are discussing this, I should buy this. No, we are not here to recommend you. All I'm saying is, what the performance is in the past. Look at what valuation these portfolios are trading in the future. Look at, are these portfolio, I always say, go level 2. Are these portfolios are aligned with what government policies are? Are these portfolios are aligned with what futuristic sectors are looking at? What has happened in the past is because of momentum which has played out, because a lot of cash has moved toward the emerging economies in 2020. We all know that in last 3-4 years. But going further, I think return making will not be that easy the way you have seen in the past. Getting a return of 12-13% compounding also from an equity portfolio of 4-5 diversified fund, as you said, Alex, will be a really good thing to have. So that's a right expectation. Take a couple of large size funds, complement it with a mid-size fund, and take maybe one small size fund, and looking at the fund manager pedigree. This is something which, as a combination, you should look at doing.
Fantastic. All right. And we'll get into the nitty-gritties of each of these down the road as well. Surprising facts that some of these large size funds have actually managed to beat their peers and the benchmark quite convincingly. Thanks so much, Kshitij, as always, for taking the time.